But Jahangir Aziz, another bond is ready.
Yeah.
So let's connect with the bond of J.P. Morgan, bond of macros. Good morning. I'm calling you bond and see you're not smiling.
I am smiling.
He is.
Oh yeah, actually bit of a delay. Okay. Can I say this budget actually has done a lot for bond market while the equity market participants say ye kya ho gaya, tax बढ़ गया, अब क्या होगा? But for the bond market, this budget has done rather meaningful changes.
I would say so. I mean, I would say that, targeting, moving the target from 5.1 to 4.9, reducing that amount of total borrowing, taking back, I mean, leaving aside the actual composition shift in the bond issuance. But I think that, it gives you a reasonable comfort that the FY26 target of 4.5% of GDP will be more easily met. And I also think that the 4.9% target probably has a lot of upside to it in the sense that they will outperform the 4.9%. That has been the pattern of this particular team in North Block for the last 2-3 budgets, and I think they'll be repeated. I think revenues are being understated in this budget. So I think, yeah, the bond market should feel good about themselves.
Yeah, absolutely. But Jahangir, I think, the other data point that I guess the markets would begin to focus in on is what's happening in the US now with Joe Biden out of the presidential race. And, I mean, it's not going to be as simple as a Trump victory, meaning risk on for equities and a weaker dollar, right? Because I guess it's the US bond yields and the US dollar, which is going to dictate a lot of money flow to emerging markets as well.
So we didn't really have that view that a Trump victory would mean good for the equity markets and weaker dollar. In fact, our view is that if Trump 2.0 happens, and if Trump follows up on his promise of putting 10% tariffs on every country in the world and 60% tariff on China, then there is necessarily dollar will have to strengthen because the other currencies will have to devalue by the amount of the tariffs imposed. So it was a strong dollar. And if you add to that, that you could see a much larger fiscal deficit in 2025, and immigration is cut back, then it would be bad for inflation. And whatever benefits Trump might bring in terms of deregulation, isn't necessarily going to offset these very big macro changes. So we had a very different view about what might happen in Trump 2.0. But now with the race being much closer, particularly in the down tickets, that even if Kamala Harris doesn't get the presidency, she could make a significant dent in the down tickets so that the House does not go to the Republicans, and therefore the red sweep is avoided, means that at least the fiscal side of US looks much better. The tariff shocks could easily happen. Those are unrelated to one another. So we are feeling a little better in the sense that you do not have a red sweep, and therefore the risk of a massive, large fiscal stimulus coming through in 2025 has been avoided. So the steepening of the curve has been sort of pushed back, which you've seen already in the market. But I think that the tariff shocks and the immigration shocks remain alive.
Jahangir, what to your mind this budget has done in order to ensure that the big blocks of the economy accelerate further? Can you specify it for our viewers? Let's say for land, for cost of capital, for labor, for job creation, because those are the things which matter.
So let's step back. So we have recorded CSO recorded growth of 8.2%. I'm not going to go into the question that the data issues related to it. Let's take it at the face value. But let's look at the drivers of growth. The drivers of growth has just been two, which has been public infrastructure and services export. Now, services export had an incredible run over the last 2 years, and it's now the growth rate is sort of slowing down and it's stalling at a high level. Public infrastructure is being pushed in this budget, probably to the limit of the capacity of the state to implement this very large 3.4% of GDP infrastructure spending. But the other parts of the economy, these drivers hadn't broadened to the other parts of the economy, not to consumption, and particularly not to private investment. So the question that needs to be asked, without going into the sector specifics, is that what did the budget do for either of them? And I don't think it made a meaningful dent to broadening the growth drivers of India out of infrastructure and out of services. Now, clearly, services is not part of the budget. The budgets did push for infrastructure, but it kept on pushing on that same lever that we have been using since the pandemic or even before the pandemic. And there hasn't been any real push to broaden out the growth drivers of India. You can talk about the skilling, focus on skilling, etc., but look at the budgetary allocation on skilling, etc. It's hardly meaningful. So again, from a growth point of view, I really don't think that there hasn't been any. May have been attempts in the budget, but I didn't see in the budget any meaningful strategy to broaden the growth drivers in India.
All right, appreciate your time, Jahangir. Thank you so much for joining in and giving us your assessment and key takeaways of the Union Budget.
If you like this video, then like, share and subscribe to ET Now.